Thank you for joining us. My name's Mark Norris. I'm a partner in the London office focusing on trade and export finance, and I'm joined with Daniela Barrdear.
Hello, everyone. I'm a counsel here, the same in the trade and export finance team at Sullivan.
The catalyst for this presentation came out of last month's Finance in Commons meeting in South Africa, which was a meeting between the national development banks, multilateral development banks, and export credit agencies. And what the idea behind Finance in Common is to try and bring together the multilaterals, the development banks, ECAs, to work in a more coordinated way to provide more support for the development agenda. And it was a very, very interesting event, but and there's certainly a lot of ambition. But one of the points raised was that there was an elephant in the room, and what that was about was actually about the multilaterals, the development banks, ECAs having all this great ambition, but the actual underlying documentation that's going to be used differs and can be labor intensive. And one of the delegates described it as the elephant in the room. So Daniela and I thought that would make a sensible topic for a webinar. So here we are today, sharing our thoughts.
Yeah, and I think also we've been having a lot of discussions with a number of risk teams within banks who are trying to also get their heads around these various products that are provided either by the DFIs or the ECAs. And although there is a lot of willingness, I think, at the commercial and the business teams to increase the number of products that are supported by these guarantees, it is quite tricky sometimes to get the legal teams, the risk teams all on board, as well as even when you're looking from a CRR perspective, trying to figure out what risk weighted or what exposure is allocated to these guarantees. So there's certainly a lot of, I think, interest in these products, but there is also a lot of caution with them as well.
Yeah, agreed. And I think there's a great quote that describes how the financial system works. And I think you can apply that to the multilaterals and the export credit agencies. And it came from a case over 100 years ago, and it said that the financial system does not reduce risk, it merely diverts it from person to person, which I think really actually sums up the challenges here, that there are these credit risk mitigants, and when you go to events such as Finance in Commons, you see the multilaterals, the national development banks, DFIs, ECAs becoming more active and absorbing more risks and becoming more active risk takers. But the challenge is the mitigants differ between agencies, and as you mentioned, the products that are offered differ and the approach to risk differ, which means that to actually deploy those products, it's not as straightforward as it should be. And I think part of the challenge is that I think the reason is a historical challenge, because I mean a lot of products, guarantees, for example, insurance, historically they were done by different industry sectors. They were segregated. You had different judgments on different products, and there wasn't much overlap between the two. So that segregation is, I think, is a factor of history and the approach of the courts. But I think certainly what Daniela and I will suggest is that there needs to be a more integrated approach to maximize efficiencies and minimize the legal risks, which is what we very much focus on.
Yeah, and I think also it's important to keep in mind the context in which these MDBs, DFIs, ECAs are putting these products in place. Yes, for the bank's perspective, it is looking at moving of risk or lowering their risk exposure, but also the DFIs have a wider policy prospect behind them. And so the reason that they are entering into various corridors that might be shut is to promote finance into various emerging markets, or there is always a policy element to their products. And so it is almost a little bit of a balance between the banks trying to use these products for their own capital maintenance requirements or for their own purposes, but as well marrying that up with the purpose that the various ECA or DFI has behind offering this credit protection.
Yeah. And so, I mean, that I think is a very interesting point, because there's a slide that we'll come to later that talks about the multilateral institutions that guarantees represents approximately 5% of their commitments, but generate approximately 45% of their private sector mobilization. So as a product, they're very effective, but certainly as we'll see, there are challenges, and navigating those challenges is critical to maximizing efficiencies and minimizing legal risk. Certainly one thing I thought it'd be useful to just touch on. So when Daniela and I talk about legal risk, we're very much looking at it from the institution who's the well, I suppose it could be the risk taker and the risk provider, but it's the risk of loss to an institution that's caused by entering into a defective transaction, which we'll come to look at, a claim being made, which is an unexpected claim which results in loss, failing to take measures to protect assets, or a change in law. And certainly I think the big challenge for legal risk around the products that we look at is ensuring that the credit risk mitigant isn't a defective transaction. And by that, and actually one thing I should say, that this definition isn't our own, it comes from the International Bar Association. But I think the critical thing for in this context is entering into a transaction which doesn't allocate the rights and obligations in the manner intended. And that could be because you've entered into a credit risk mitigant thinking it's one thing, it turns out to be something else, and so it doesn't work in the way intended. Or entering into a transaction that might be held to be void. And that's a particular challenge with sovereigns. So certainly, and I suppose this is what leads to a lot of the delays or the costs when you're looking at using credit risk mitigants, because certainly from the lawyer's perspective, they're very much focused on minimizing the legal risk. Yeah, so I mean, this is a challenge, and it picks up. So I mean, this is an interesting quote that came from a publication that talks about that was looking at development guarantees and the Basel regulations, and picking up on your point in terms of the mission-led. So, I mean, the guarantees represent 5% of the commitments of the multilaterals, but generate 45% of their private sector mobilization,
And I think this was looking at Africa in particular, right?
possibly,
Sub-Saharan
yeah.
Africa, I think.
But I mean, the
That
multiplier
was the same.
effect is really quite significant. I mean, I imagine it would apply globally, but it may well have been Africa. And they recognize that there could be much more, and the challenge is there's this misalignment of the global regulatory architecture, and we've got some other interesting quotes that actually talk about the lack of resource capability. And I think part of the problem about the misalignment is that a lot of these products, so if you're looking at guarantees or you're looking at insurance, previously it was all segregated. You didn't have the same people doing it. Now you've got the same people doing it. And unless we address these issues, as this report says, the ability to achieve the sustainable development goals may be limited.
Yeah.
This was a report from the OECD, and it was calling out the lack of standardization across development finance providers, and that leads to more time being spent on the negotiations as well as higher transaction costs.
It's difficult to also think. I think this is something that has been identified by a number of institutions who are the beneficiaries of the guarantees. And we definitely see it, especially from the bank's perspective. Often banks will get their heads around and get used to one particular provider. So if you're looking at ECA guarantees, only looking at UKEF ECA guarantees, but then moving to a SERV or another ECA, it's actually quite time consuming getting your risk legal teams on board with these new types of documents. It takes a very long time, and it may not be worth pursuing. So it's certainly one of the issues that gets raised. But then on the other hand, we've been talking recently about, well, does this mean that you could have one particular DFI or MDB that comes into play and says, all right, we're going to standardize a number of these provisions, for example, the environmental and KPI requirements. Are we all going to start adhering to the same schedule or looking at these same in a coherent way? I don't think we're seeing that conversation yet. Be interesting to know if anybody else has other outlooks, but it's certainly something that is being called for by the market.
Yeah, I mean, certainly, I mean, this is an interesting quote because it talks about development organizations lacking the operational capabilities to provide the guarantees at scale. And I think that standardization in terms of format, setting out whether you're providing guarantee insurance, what the claim process is, what are the exclusions.
Yeah.
I mean, the claim process in terms of times doesn't have to be the same between institutions. Likewise, in terms of the exclusions, but if they were worded in a similar fashion and set out in a similar way, it would certainly address the concerns that many of these reports are raising.
Yeah.
This is another quote from the OEC, but it just reiterates the challenge in that deploying the guarantees requires specific financial and risk management expertise, which may not be readily available. I think part of that can certainly be addressed in terms of standardization and better understanding what you're getting into. And also, I mean, I think part of the challenge is, and we'll look at this in a while, but recharacterization and the legal risk where you think you've got one product, but it actually turns out to be a different type of product. And actually, just this quote from the OECD, they define guarantees as a type of insurance policy protecting banks and investors from the risks of non-payment, which is fine in principle, but legally, a guarantee works differently from an insurance product.
Yeah, and one of the main reasons that I think we become involved in a lot of these products is where we have clients that are coming to us to help them analyze the product from a CRR perspective and looking at not just what whether or not the qualitative requirements are being met. So we know that under CRR, we need to have protection that it be considered to be direct, incontrovertible, and that it does not sit outside of the control of what the lenders, is going to be able to meet. So the conditionality element. But also we are getting asked more and more to look at the actual weight that is given to a particular product. Because if we think about it, a number of these products are being provided by entities that are either direct state-owned, so you have the risk weighted of the sovereign. That's very easy to understand. A lot of the MDBs and the DFIs are actually named in the CRR legislation. And so you know that a guarantee from this entity is giving a zero risk weighting. That is quite easy. But then there are also other entities who are counter guaranteed by a sovereign. So they might be a private entity. And you need to look at the conditions or the parameters within which that counter guarantee is given in order to allocate that zero risk weighting. And that is more of a laborious process. So there's a number of elements that come into play and a number of considerations when we are looking at the CRR treatment and looking at who these entities are, the charters that govern them, or even whether the product is being given that is within the legislation that set up that institution, whether or not they are acting ultra virus. That's quite an effect.
But I mean, in terms of so someone who's a protection purchaser or getting protection from a multilateral, so I mean, if it's recognized from a CRR perspective, you've still got the issue about enforcement. So if someone asks me how do you enforce against UKEF, that's you can look at the legislation, Crown Proceedings Act, and see how one makes a claim against a sovereign.
Yeah.
In the worst case scenario, yes. Because
it's in legislation. It is actually
yeah. So what if you're a protection purchaser
for DFIs
and you've got a DFI? How does that work? I mean, you mentioned
the charter. It is written just as it is written in legislation. These entities have been formed by treaties or by charters, and there are procedures in place. Also, there are limitations, but it is understanding those limitations. There is often this almost a perspective that these bodies are actually immune from prosecution. They do have immunities, but often these immunities are only in relation to assets. So for example, with IFC, you can bring process against IFC, but you cannot go to the assets and try to take funds out of, recover funds out of those assets. Proceedings can still be brought. So it is understanding what the differences between all of these are that helps get, I think, the risk teams to help the legal teams at various banks comfortable these entities. EIB is another example. Any process has to be brought under European courts. Logical, but that is a restriction, of course. So, yeah.
So, but and your experience in terms of, so when I issue legal opinions and you're dealing with sovereign, it sets out how you make the claim and
Yeah.
what the process is.
And when we issue the legal opinions in relation to the MDBs, we look at the charter.
Yeah.
And we will reference the charter and we will reference the various proceedings because we have to look at it as a whole.
Yeah. So it's still on the theme of credit risk, on the credit risk itself. I mean, you mentioned about counter guarantees. So indirect guarantees are recognised in certain circumstances as a form of credit protection.
Yes.
Direct, clearly, you've got guarantees and insurance, and then there's synthetic credit risk mitigation, which earlier this month the Basel Bank for International Settlements announced that they were actually going to be carrying out a deep dive into synthetic credit risk mitigation. I don't think that, certainly I think from the bank, from the export credit agency perspective, it's very much guarantees, insurance and counter guarantees. I don't see much
of the synthetics and derivatives. No, not yet. I think that there is a bit of an increase in exploring those types of products, but I don't think that it is as widely used as the others yet.
Yeah. So certainly in terms of what we're going to look at, it's very much focused around insurance and guarantees, and one of the big issues is about recharacterization. This issue, the legal risk about knowing what you're going to get, because just because something's called an insurance or guarantee, and we saw this with the quote from the OECD, that those phrases are often used interchangeably. And there's a number of UK cases that involved export credit agencies where products were issued which were termed guarantee, but then it was held to be an insurance product. So it is critical to actually properly understand what one's entering into, and whether something's called a guarantee doesn't necessarily mean that it's not actually an insurance product, and that which opens a raft of other issues, which, from a legal perspective and managing legal risk is critical. Very much comes to that point touched on earlier about standardization.
Yeah. And what's the risk of it being recharacterized into insurance?
Yes, agreed. And actually on that, perhaps, well, I suppose if we just go to, so I mean, in terms of, I think what the multilaterals are offering is getting broader and broader. I suppose guarantees and insurance are probably the bedrock of medium to long term cover. But certainly what the challenge is, and actually if we just jump a few slides forward. Yeah. So I mean, certainly challenge, and it was picked up by those UK cases, and why you need to get lawyers involved, and perhaps the reason why there's been so much concern about from the OECD that it's just too labor intensive, but recharacterization is a risk. So I mean, in essence, and which came, there've been a number of UK judgments, but in essence, in characterizing a transaction, the court looks at the substance and then the form, and when it's characterized it, when you've construed the contract and decided what it says, then it's a question of characterization. Is it a guarantee? Is it an insurance product? And it's very relevant. There's a case earlier this year where the court held that a document that was called a letter of comfort was actually a legally binding document and constituted a guarantee and indemnity. And certainly, I mean, the great thing about recharacterization is that there are some memorable quotes which actually I think bring the point home. So a quote from the 90s about if the transaction is a cow and has cloven hooves, parties cannot turn it into a horse by using equine terminology. There's a typo there, or saying it is a horse. And another great quote from the 80s, the manufacturer of a five-pronged implement for manual digging results in a fork, even if the manufacturer, unfamiliar with the English language, insists that he intended to make a spade. I think those comments are flippant, but they do bring home the point that there's a risk here that you end up entering into a form of credit risk mitigation that you weren't expecting, and because of the way that products have developed historically, a different set of rules might apply.
Yeah, sorry, I forced you to jump around. Back to looking at the.
So I mean, the obvious one around credit risk mitigation is the differences between guarantees and insurance. I mean, certainly from that quote from OECD, the end user might see them working in the same way, but there are important differences, particularly now under English law, that you've got the Insurance Act, which replaced the previous law around insurance. And under the Insurance Act, there's a duty of fair presentation. So if you've got insurance, there's a duty of fair presentation. If you've got a guarantee, the duty of disclosure is much much weaker.
Yeah, but I think it also then means that it's almost a reason why we see that these guarantees probably laying out or specifying a lot more of these conditions is because they don't have the protection,
Correct,
let's
yes.
call it, that the Insurance Act provides insurers.
Yes.
Whereas those conditions are still there, but now they're almost set out in the document. They have to be negotiated, explained. And it also means that these guarantees, let's say if that they are conditional, as in, not for the CRR purposes conditional, but in terms of meeting certain criteria in order to stay on cover, it means that it is so much more important for the various teams, banks, or the beneficiary of that guarantee to understand that criteria, ensure that what is being covered meets the criteria, but also doesn't change during the life of the cover. Like you would with an insurance product, it's just that it isn't detailed in the document.
Yeah, agreed. I mean, a well-drafted guarantee would look to put those provisions in. But I suppose what the challenge might be is that if you've got a guarantee, and if it's got disclosure obligations, and we'll come to the duty of disclosure later, what happens if you don't actually comply with the limited law around guarantees and disclosure? And I think coming back to your point, it's critical that a risk taker understands what those obligations are, because particularly with guarantees and insurance, you don't want to risk going off cover.
Yeah.
So if you have not complied with the terms of the guarantee, because English law is very protective of guarantees, and usually when you've got a corporate parent company guarantee, those English law protections of the guarantor are waived, so you can extend the underlying financing, you can increase the amount, you can amend and restate. Those protections are not, so those protections remain when you're dealing with an export credit agency guarantee.
Yeah, and I think it's worth touching on, we use the term guarantee, and the industry and the market uses the term guarantee to mean all sorts of different products. So often we see products that are called, and that purport to be on-demand guarantees. And these are not, are almost different from, for example, the UKEF type product that we see, that it is a guarantee that keeps or grants the guarantor the protections that we usually see under English law. So if you were to look at a corporate guarantee, or if you think that of a corporate guarantee that you would usually get from a parent to a subsidiary, you have all of those provisions where the guarantor agrees to waive any of its rights that are granted to it by law. It agrees to not compete in the recovery of proceeds, even though those rights would be granted to a UKEF type body. They are not being waived.
Correct.
For other reasons. I mean, it's a different type of product. But then you also hear the word guarantee being used when you're looking at risk participation agreements. And in that situation, although the risk participant, and in this case, many of the DFIs are taking on this guaranteed role, this is a very different product. And so those rights that may be granted to it as a guarantor do not arise.
Because it's not a guarantee.
Because it's not a guarantee.
Yeah.
Even though often it is called a guarantee as well. So just put it.
Well, I mean, that was like the recent IDB case where a letter of comfort was issued.
Yeah.
The bank called against the letter of comfort. The person that granted the letter of comfort said it's a letter of comfort, it's not a guarantee. But the court held that it was legally binding and did constitute a
guarantee.
Yeah, and indemnity.
So it's again with that jargon that really confuses things, but here we are.
And well, this is picking up on the point that you just touched on, that those ECA guarantees don't have those waiver of defences. So actually managing your operations is critical, so you don't unintentionally end up off cover.
Yeah, and it's also one other thing to mention is we mentioned it before, and when we look at the conditions or the list of criteria that needs to be met in order to stay on cover or to have a product covered, often because of the ongoing nature of these guarantees, or the fact that they're put in place on day one, but they're expected to be available or around for many years to come, and to cover various products that either come in under the cover or fall out of the cover. It also means that we see banks having to put a lot of resources into managing that guarantee, ensuring that the various deliverables are met, but also in terms of monitoring the products. It is time consuming, I would think, because years have passed, the various person that put that guarantee in place has left. And this happens at the DFI level as well, in both institutions. Those entities who signed the guarantee are no longer there. But yet you are thinking, okay, this product will be covered because it has been covered in the past, but there has been a slight change that has been made. A jurisdiction that wasn't covered, or even an amount is greater than you would. Those are the easy ones. But there may be reasons to constantly go back to the guarantee and see if that product is still covered. That's quite time consuming and labor intensive. So.
And I think there's a very good point there in terms of I think particular risk as tenors get longer on these financings.
Yeah.
If the reporting obligations remain, so your ESG reporting, fine during the operations phase, everyone's focused on that. I mean, during the construction phase, everyone's focused on that. But if you've got a long tenor and the operations phase goes out for that 12 years, someone's got to remember to keep doing that monitoring. And what you don't want is 7 years in, someone in the bank in the back office says, oh we don't need this. The borrower says, oh, do you still need this? And the person in the operations team says, no, we don't need it. And then you fell foul of not delivering in terms of that monitoring, which I think is a challenge. And I know it's been raised a number of times around the ESG reporting, particularly with these longer tenors. Does it need to continue? And as you say, I mean, there's a risk if it stops, then you don't want to end up finding you're off cover because you should have been getting something and you didn't get it. But this is the, yes, I mean, the point about recharacterization, documentation risk. So you often hear about people, some institutions take it, others don't. I'm not sure. As to what it is, to my mind, it's where if a bank's not, if an export credit agency is not taking documentation risk, means that it's not going to pay if the underlying facility agreement's invalid, illegal, or unenforceable.
And this is where the legal opinions come into play, or become much more necessary, I think. And the due diligence at the beginning when the transaction is being put in place is much more critical.
Yeah. And I suppose there, I mean, is because some export credit agencies do cover documentation risk, others don't. And properly understanding who is taking that risk. And what about with multilaterals and development banks?
We have less of that distinction. I see this more often coming up in the ECA. I think so that a lot of the guarantees that I'm involved with the DFIs are more from the risk participation type side of things, and so that is the documentation rather than there being an underlying loan that the guarantor simply sits above and is willing to take some level of risk within it. But obviously the parties who are entering to the document are the ones that are seen to be sophisticated enough to put in place a document that is enforceable.
So the multilaterals are not taking that risk. They're saying we can't check whether it's enforceable. It's down to you to check.
Yeah, exactly. But it's a different product.
Yeah, understood. And of course, the documentation risk is in addition to all the other exclusions that you need to properly understand in terms of.
Yeah, very much. And I think it goes back to the thing that we're constantly being asked is a bank or an institution gets very comfortable with one ECA and that one documentation. They know that they will not take documentation risk, and so the ECA becomes involved into that loan agreement or the negotiation of that loan agreement as if it was more than a syndicate lender, almost party to that loan, because you want to make sure that you're meeting all of its requirements.
Yeah.
So that
because it's going to have policy issues.
Because it's going to have policy issues.
Yeah.
Exactly. So you have that scenario, but then with other entities who do take, it's serve recently that we were talking about, who do take documentation risk or are willing to take it, it's less of an issue. And they may not be as involved in the underlying document from.
Yeah. Well, so clearly understanding who's taking what, as well as the exclusions is critical from managing that legal risk. So it's something we touched on earlier. I mean, there's a sense that environmental and social due diligence is becoming too much of a burden. And I think you're very much on the point. So not only doing the due diligence ahead of getting the credit support, but then the ongoing due diligence and who's bearing the cost of that.
Yeah, and we were asked recently, and this morning actually, whether or not we are seeing these ESG and due diligence provisions being harmonized across various ECAs. Seen that at all. It'd be interesting to see if anybody else is.
Well, I suppose where they'll say
that baton on.
Harmonization comes through the sustainable development goals and whichever institutions are signing up to those climate commitments. But even there, I mean, even if you've agreed what your reporting indicators are, then the question is how long are you going to do it for? Is it going to be for the whole of the loan? Because that's a big cost and it increases the risk of going off cover. But assuming that you've complied with everything, and in the worst case situation happens, there's a potential claim. But I think the key thing there is properly understanding when you're entering into the agreement what that claim process is. I mean, clearly certain provisions will directly impact on the regulatory treatment, but other provisions may just say it doesn't affect the regulatory treatment, but how the bank is expecting to conduct its business, there might be an impact.
Yeah. And you have a really big difference with the waiting periods, or, some institutions are very clear in saying that, following a breach or following a default, that there will be an automatic period that starts, that is the 90 days, 180 days. They will agree to pay interest, normal interest, not default interest during that time. But it is also seen as a period where information will be gathered, be looking to speak to all the various parties. It's a very busy period, looking to make recoveries or seeing what went wrong. But then in other instances, there is an on-demand element to the claim. You as the risk taker or the beneficiary of the guarantee are asked to represent that this falls within the category. You put in a claim or a payment is made within 5 business days, very, very quickly. But then you might have the ability, the DFI, to review that claim. And if it was
So that's
not
probably
made-
understanding what is a valid claim.
Exactly. So you need to know at the onset when you're making that claim that it was valid, because there will be a clawback right within that documentation, which forces you to give the monies back if the claim was not legitimate. So it might be that you have a quicker turnaround or a quick payment, but there is the risk that it was deemed to be invalid. And it is clawed back. So various different ways of approaching this.
And then so one thing differs between export credit agencies is whether they pay interest during the claim waiting period.
That varies significantly.
But interestingly, there was a UK case which was in the context of export credit insurance. Well, I've not read the case, but I don't think so interest wasn't being paid, but the court held that the beneficiary of the credit risk mitigation should be compensated for being kept out of the money. But I think it's an important thing to understand when you enter into the credit risk mitigation, whether you're going to be paid, and if so, whether it's at the non-default rate or the default rate. In my experience, you are paid, it's at the non-default rate.
And there's also a lot of jargon that comes into play. Earlier, you used a word that I didn't know,
The spike.
The spike. Some ECAs will not cover the spike interest. That was a new one for me.
So full of jargon, but I mean, understanding that claim process is I think is clearly critical in terms of managing those legal risks to make sure you're getting what you expected to get, and when you're going to get what you're expected to get. I think one thing that actually comes up quite a bit is around the disclosure, because and this very much reflects the point we touched on in the first place, that the guarantees develops under a separate legal regime from insurance, so that there are separate regimes. The insurance regime has different disclosure obligations to the guarantee regime, but as you said, that with guarantees you can address it contractually. But it's certainly important to understand that under a guarantee, the disclosure obligations really are very limited. And
There's no duty, right?
well,
Or
the
in statute.
duty's very limited. It's not a statutory duty, but there's a limited principle of the disclosure of unusual features, and save for that, guarantor is expected to look after him or herself, which they would do through that on that contractual side.
Yeah.
And the reason for that is contract guarantees, not a contract of the utmost good faith. But then I suppose what you need to be careful about is what happens if what you thought was a guarantee is actually an insurance policy, which I mean we've seen cases that have said that what's termed a guarantee is actually insurance.
And therefore protected by the Act.
I think, well, they were
All
pre-Act cases, but
Oh,
so
okay.
post the Insurance Act, it would be covered. But it's been held by certainly in the English courts that the duty of disclosure in relation to guarantees is very limited. So you would need to
document.
Yeah, to get the same thing as fair presentation, which exists under the Insurance Act. And I think when taking out guarantees or insurance, it's critical to understand what your disclosure obligations are, whether they're contractual or by virtue of the Insurance Act. Because I think in both cases it can render your credit risk mitigation worthless. So it's but for insurance, it's clearly set out in the Insurance Act what you need to disclose and when, and what fair presentation means, the manner of disclosure, the materiality.
Yeah, it's all documented, and there's an abundance of case law as well that helps.
Well, I'm not sure.
That's after the
Yeah,
Act,
I'm not
no.
sure if there is actually.
It's all been clarified
But I
by
think
the
it is.
Act.
But I think it's clarified.
Okay.
But I think it's certainly with the guarantees, it's from the cases that duty of disclosure is limited.
Yeah. No, it's interesting. I mean, for me, it's interesting to understand that because I definitely come from the guarantee side of things rather the insurance market. But it is often clients who have been used to taking out guarantees are now looking at getting the same product, let's say, but from an insurer.
Yeah.
And that documentation.
Well, I mean,
is
some export
completely
credit
different.
agencies give export credit insurance as opposed to export credit guarantees.
Exactly. And so you are now looking at a product that almost has the same effect, but it is very different, both in terms of how it is written and what is contractually agreed, but then also in terms of the implied obligations that you have, because it comes with the protection of the Insurance Act. If it is
Yeah.
covered by English. So yeah, we're seeing that crossover quite a lot.
Yeah.
So keeps us on our toes, I
It
guess.
certainly does. And I think, yeah, certainly I think what this presentation shows, it really does emphasize the points that have been picked up by in the reports and the development reports, that if things could be more streamlined, it would there are potential blockages and delays because of these differences.
No, definitely. And it is something to look at. I mean, it'd be interesting to know if there is a willingness from the DFI side or from the multilateral side to take this challenge on and maybe be the one that harmonizes.
Well, I think with
some of
financing
these.
commons, there's a big willingness to do more, but I think I mean, it was interesting at that event, someone said, well, this is the elephant in the room. You've got all these people with these grand ideas about how much money can be deployed. Yeah. And if for a multilateral, from a 5% commitment, you can get 45% of your private sector deployment. It's a pretty effective tool.
Absolutely. That comes to the end.
It does. I mean, is there a
Representation officially.
question function, do you
Let me
know?
just double check. We do have a question function. We don't have any questions there now, or if anybody,
If anyone has any questions,
put it on. If not, our details
yeah,
are.
so if you
or
do
both
have
our
any
details.
questions, do please get in touch. This is certainly a very interesting area, and certainly we're going to see the DFIs, multilaterals, export credit agencies doing a lot more over the coming years.
Absolutely.
Well, thank you very much for joining us.
Thank you all.